People have been living in this bubble where the interest rate have been 1 or 2%.
So when you say part interest, part capital, how exactly does it differ?
So let me answer that question.
Now, when you say repayment vehicle, it reminds me of cars.
These things are where you need advice.
Hi there, welcome back to another episode of Let's Talk About Mortgages. And today we'll be demystifying the topic of part interest and part capital, or is it part capital, part interest? Well, stay tuned to find out furthermore on this topic of Let's Talk About Mortgages as I join hands with Iftikhar Mohammed, who is a mortgage advisor and also an accountant and has been so the best of both worlds for the past 10 plus years. Welcome back, Ifti, on this episode of Let's Talk About Mortgages. We have a lot of questions on part interest, part capital. As a homeowner whose mortgage interest rate is now up at about 5.5-6%, whose monthly payment has gone up by about 600-700 pounds. I'm literally crying inside right now because almost 60% of my salary has been eaten up by my mortgage, and I'm finding it difficult to manage while I have so many other expenses going on amidst the cost of living crisis. I'm saying all of this putting my homeowner hat on. How is it, Ifti? What's going on in the market?
Good question you asked. Yes, the market has changed quite a lot over the past couple of years. Interest rates have been going up. People have been living in this bubble where the interest rates have been 1 or 2%. So you're used to that lifestyle. Now suddenly the interest rate's gone up to 5 or 6%. So that's sort of 4-5 folds to some people. So that's a lot of money for a lot of people, and they're not used to it. So obviously the market is adjusting to that. People are looking at options. Some people are extending their mortgages. Some people are looking at interest-only option. But part interest, part capital is another option as well. So that's a good option for certain people. It's not for everybody, but it works very well for certain people.
On that point, I think many of us have hit the rock bottom of this dismal market, mortgage market, I'd rather say. And when I hear the word part interest, part capital, I mean, I'm already paying both interest and capital towards my mortgage. It's been taken out of my bank account by the bank every month for both elements. So when you say part interest, part capital, how exactly does it differ from a regular mortgage that I am on currently?
So let me answer that question. Now, usually mortgages are called repayment mortgages. I'm talking about residential mortgages here. They are repayment mortgages. So if you take a loan of say 200,000, I'll use 200,000 for this example. So you pay that 200,000 over 25 years or 30 years, whatever time period you agree to do. So you pay interest plus capital, and at the end of the 25 years, let's say, you settle off your mortgage. So that's your traditional mortgage. So then you have something called an interest-only mortgage. That's not very common now unless you're doing a buy-to-let. So people who have buy-to-lets are very familiar with interest-only mortgages. So interest-only mortgages, you borrow, let's say, 200,000. At the end of the 25th year, your balance is still 200,000, but you pay interest only for that 200,000 over the period of time. So that's that. So this part interest, part capital is kind of like an in-between. So where people take, let's say, the 200,000, they break it into two for argument's sake. So on 100,000, they pay off that mortgage over 25 years. So they pay interest plus capital, and that mortgage balance becomes zero. The balance 100,000, they only pay interest. So they don't pay that loan at all. So at the end of the 25 years, you still have 100,000 remaining, but whereas the other 100,000 has been paid off. So that's part and part.
Thank you, Ifti, for very well distinguishing the differences between part interest, part capital and a regular residential repayment mortgage. Now, am I really eligible for this? Because I am really struggling with my monthly payments because it's quite significant, and I do anything to reduce my monthly payment as much as possible. So, am I really eligible for this mortgage? Like, what is the criteria I have to meet?
Okay, so let's go back a few years. If you go back a few years, the banks used to allow people to have interest-only mortgages. So when you get an interest-only mortgage, what the banks used to take is to take an endowment policy. So what an endowment policy does is, it's like a savings account. So you pay interest only, but you put money into your endowment policy where, the provider will sort of invest that money somewhere and give you some return. That's the idea. So at the end of, say, 25 years, whatever is remaining in the endowment policy, you get that money. But for whatever reason, endowment policies, became very unpopular because there was some bad history, like maybe some mis-selling and things like that. So because of that, endowment policies don't exist anymore, right? Because people don't like. But, banks are very careful doing interest-only mortgages. Now, the reason I'm talking about interest-only is because, part of the mortgage is anyway interest-only. So they are still very careful about who they will give a part and part mortgage. Because remember, part of the mortgage is interest-only. And the banks don't like interest-only because of the bad history that you've had over the past. So not everybody is eligible, you are right. So people who are eligible are people who generally have a bigger deposit, because bank wants to make sure that they're lending to the right client. So they'll want people to have a bigger deposit. Usually, this is just a rule of thumb, you might have to have a 25% deposit at least. Some banks say it's not 25%. You need to have a deposit of, say, 300,000 or 250,000. It really depends on the bank, right? So it can be lower as well. So you will have to have a sizable deposit to start off with. And the second thing what they'll want is, they will want a repayment vehicle. Now, what happens is, if you use the same example, you have 100,000 remaining at the end, right? So how are you going to settle that 100,000? Because remember, it's your main residence. It's not a buy-to-let property. You need a place to live, right? So if you need a place to live, how are you going to settle that 100,000? Because by the time you finish your mortgage, you might be 70 and you have no other ways of earning that 100,000, because we don't know what your health is going to be like, right? So you will want a repayment vehicle. Bank will want to see that. So subject to that and subject to having a higher deposit, banks will consider this. But all banks don't offer part interest, part capital mortgages. Because of the past history, some of the banks are quite shy to take this on. So, but there are banks who offer this, and some of the bigger banks offer as well. So those options are there, but for the right people. Because remember, end of the day, a mortgage is a big loan. The idea is you settle that, because you don't want to be in a situation where you have 100,000 to pay suddenly, right? So, because sometimes people think, that's 25 years down the line. It doesn't matter. We got a long way to go. But remember that 25 years will come quite fast, right? And you don't want to be in a situation where you don't have money to pay off that loan and having to sell the property. So that's not a situation you want to be in.
Right. On that note, I do have a question. Now, before I dive into the repayment vehicles, which you just mentioned, assuming that I'm on a residential mortgage currently, a residential repayment mortgage rather, is it possible for me to speak to my lender, whoever it is, Halifax, Barclays, Skipton, HSBC? Is it possible for me to speak to my lender and convert it to a part and part mortgage? Is there a possibility?
Yeah, you can try it with your existing lender. Like I said, subject to you meeting this eligibility criteria, they will consider. So you don't have to use your existing lender. You can even go outside, because if your lender doesn't do it or you don't fit their criteria, there might be other lenders out there. Again, try and get advice on this, because if you go to a broker, they deals with, quite a lot of banks. So because they deal with a lot of banks, they will give you the options. So for example, let's say you only have 150,000 as deposit. There'll be a lender who will be out there, but it may not be your bank. And likewise, if you only have 25% deposit, maybe that 25% deposit equates to, say, 100,000. Not all lenders will take that, but there are some lenders who will do that. But an advisor who deals with these banks regularly, they'll know which banks to go.
So you said we have to meet the criteria and all of that, right? And I'm assuming that part of the criteria is for you to have a verifiable or a repayment vehicle that is acceptable by the lender. Now, when you see repayment vehicle, it reminds me of cars.
Yeah.
I don't know, for whatever reason, I'm thinking of, putting my car as a repayment vehicle to the bank.
Yeah.
Is there an acceptable vehicle of
Probably
repayment.
Probably not. Banks are very careful about this repayment vehicle. Repayment vehicle is nothing but how are you going to settle this loan right at the end of the term. That's what they're after. Usually what's accepted is something which, is more or less guaranteed. So for example, if somebody has a pension scheme, a lot of people contribute towards their pension while they work, right? Because they say, okay, 10% of my salary goes to pension, or 5% employer contributes as well. You build up a pension pot eventually. So if you have, pension pot, you can consider that as a repayment vehicle, because bank knows that you can't withdraw that money today and spend it on your parties or going on holidays or whatever it is. So they know that money is secure. So something like that is something banks will accept. And also buy-to-let properties in the background. So for example, some people have a second property or a third property which they let out, but there is equity on those. You may not have, 100% equity on this property, and you may have, let's say 25%, but you might have 25% somewhere else and 30% somewhere else. So all those can be considered as repayment vehicles as well. So that's the most common one which I find through our clients, because a lot of our clients have buy-to-lets in the background. They use that as a repayment vehicle. But of course, pension is the other one. So those two are the most popular ones. But certain banks, not everybody, this is where you have to be careful. Certain banks will accept things like ISAs, right? Generally, it's not the cash ISAs, but, investment ISAs or some kind of investment schemes that you have. Especially things like if you have bonds and, unit trust sort of thing, they will consider those because they are considered more like a long-term investment. So banks will consider that. But again, like I said, it really depends on the bank. It's always best to get advice on this area because, you might go to your bank and your bank might say, we can't give you the mortgage. But then if you have, unusual repayment vehicles, it's always worth checking around. If you go to the right advisor, they usually know which bank will do what. So you might still find a solution.
All right. So another repayment vehicle that is lingering in my head is bonuses. Yeah. Now, let's say I get paid a huge bonus every year, not every month, of course, every year. Can that be a repayment vehicle to the lender?
Probably not. Obviously, these kind of things are specialist areas. If an experienced broker, they will speak to banks and see whether there's a way around it, because that's the relationship they have, right? So, for example, I have good relationships with certain banks. I can have those conversations. But generally, it's not, because bonuses are not earned income. So today you might be with X company. Tomorrow you might go to Y, and Y may not give you a bonus. So that's not guaranteed. So banks may not consider that. They generally want something a bit more stable and, which is more secure. So things like houses and investments in shares, investment in, investment ISAs, pensions, all of that is more like long-term investments rather than short-term ones. So they are more inclined to go for those.
Right. So from the sounds of what you said, it has to be very well established assets that grow in value and can be sold later on, isn't it?
Yes, that's right. That's the idea.
Right. Okay, so looks like bonuses are out of the way for the moment. But what about cash? What if I've saved up a hefty amount of money, maybe for rainy day or for some sort of an emergency? Can I still use that as a form of repayment vehicle?
Not really, because cash, even if you have a good track record of saving a lot of money, cash can be used like that, right? Because it's easily sort of usable. So therefore, banks don't like it. People ask me a question about cash ISAs as well, because ISA is effectively a saving scheme which is sort of kept for the long term. Again, you have instant access. So if you have instant access, that's when banks get a little uncomfortable. I've been asked questions about things like gold as well, because some people have invested money in gold, right? Generally, gold is also very liquid, because especially with the gold, nowadays people invest in e-gold or a paper gold, right? Where you don't really physically keep any gold bars, but whereas you have that. So those things are easily convertible. So therefore, banks don't generally like that.
So I'm assuming even it's the same with cryptocurrency as well, because cryptocurrency has been gaining a lot of popularity over the past couple of years, especially last year when Bitcoin was doing so well at $70,000. Would cryptocurrency do as a repayment vehicle? I'm assuming not.
Again, we can have these conversations, but as a general rule, banks don't like cryptocurrencies because, again, it can be easily converted into cash. If it's easily converted in cash, you can use it for something else. They're more interested in where it's less liquid, right? The lesser liquid, there's a good chance that they'll accept it.
Okay, so now that we've discussed the acceptable and unacceptable vehicles of repayment, what are actually the pros and cons of this type of mortgage? Because obviously, as much as it would reduce my monthly payments, I know at the back of my head, I am thinking, okay, maybe it's not the best solution in the long run, although it can mitigate the immediate problems that I may have in terms of making monthly payments, because rates are not going to be on a higher level all the time.
Yeah.
They will at some point come down, isn't it? So what are the pros and cons, if you can explain it briefly? Yeah.
Okay, so let's look at the pros first, or the advantages, because it's very relevant for today's context. The main reason why people do this today is because if you're doing part interest and part capital, the monthly repayment will be lower than a repayment mortgage. Because with a repayment mortgage, you pay full interest on the loan value plus, your capital, right? So that's the biggest advantage. So there is a cash flow benefit for people. So that's why they will do this. And obviously there's flexibility as well, because I have clients who take part interest, part capital mortgage, just to make sure that, in case they are struggling with their mortgage, they have to pay less. So if they're not struggling, they'll go and overpay. So that flexibility is there so for example, if it's a £2,000 per month mortgage, part interest, part capital, maybe 1,500 or whatever it is, right? So if it's 1,500, for argument's sake, they have that luxury to pay £500 extra every month. So that gives them that flexibility. So in case, things are difficult, say for example, self-employed or somebody who's a contractor, if they have a bad patch in between, they only have to pay 1,500, not 2,000. So therefore, it gives them that flexibility. So that's the second advantage you have. Obviously, I think compared to interest-only mortgages, I think this is a little better. Because if you go 100% interest only, which is possible as well, right? Because if you have enough assets, they will give you one. But remember, you're paying off your loan, right? Compared to 100% interest only mortgage. At least part you're paying off the loan. So at the end, you don't have a bigger balance to pay compared to interest only mortgage. So that's a definite advantage that you have as well. So the other advantage you have is you pay less interest compared to interest only mortgage. So what that means is, if you take a loan and half of the thing is being paid off, over a period of time, you pay lesser interest, right? Because your loan has been coming down. But if you have interest-only mortgage, you've only been paying interest. So, it's like a flat line. Your balance is never reduced, and you're paying interest over 25 years in this example. But whereas if you have a part interest, part capital, your balance keeps reducing. So that means you're paying less and less interest. So that way you can save money in the long run. So that's sort of a advantage that you have as well.
So on the flip side, what are the things or what are the factors that I need to be taking into consideration when going ahead with the part and part? Because of course, part of my mortgage is on a repayment basis, but at the same time, it's on an interest on the basis. And I'm only paying interest, and that part of the mortgage is not going to reduce until I move it to a repayment mortgage or maybe make overpayments towards it. So what are the factors that I have to take into consideration on the flip side?
Okay. So again, the idea of having a mortgage is you settle your loan at the end. So if you're doing a part and part, what happens is you're not settling the full loan. So you have a big loan to pay at the end. Let's use the same example. Out of the 200,000, you would have settled off 100,000 at the end of 25 years. But the other 100,000 is a big amount that you need to pay at the end, right? So you need money for that. So that's a big disadvantage. The second disadvantage you have is the interest. So because, on the 100,000, you will be paying interest 25 years. right? But if you are doing a repayment, your balances keep reducing. So therefore, it's going to cost you a lot in the long run. So that is definitely a disadvantage. And then the banks itself, not all banks will offer you a part interest, part capital mortgage. The other disadvantage is not all banks will offer you a part interest, part capital mortgage. And even if they do, they will have certain conditions, right? So they'll say you need to have a minimum 25% deposit or 100,000 deposit or whatever it is. There will be conditions. So not everybody will be eligible for that as well. So that's something that you need to bear in mind. And also, the other disadvantage is you might have repayment vehicles, for example, a buy-to-let property, right? But maybe somewhere down the line, you might decide to sell the buy-to-let property for various financial reasons. So you might have a part interest, part capital mortgage, but you don't have that repayment vehicle anymore. So you're going to be left with a big balance. So you have to be very careful on this. So it's not recommended for everyone. But it's recommended for certain people, but these things are where you need advice on, because remember, mortgage is a massive loan and it's always best to have as less loans as possible. So my final point on this, which is a big disadvantage, is this mortgage is not for everyone. You probably want to get advice on this, because this mortgage is meant to be for only certain people. If people are not very good at managing their finances, this may not be your mortgage. So always get some advice before you go to a scheme like this. As good as it sounds, it's not good for everyone.
All right, Ifti. So now that you've explained what a part capital, part interest mortgage is, are there any ways of reducing my monthly mortgage payments? Because of course, like I said in the beginning, they are substantially high. So what are the alternatives to that?
Yeah, there are some alternatives. Obviously, part interest, part capital mortgages work for some, not for everybody. And it's not a scheme that we actively promote as well, because like I said, the problem you have with this scheme is you're still left with a loan at the end. But a lot of people, they try to extend their mortgage. So for example, if you're struggling to pay your mortgage, maybe it's an idea to extend it, right? So for example, let's say your mortgage is 25 years. So you might be able to extend it to 30 years or 35 years. So that will keep your mortgage payment down, but at the same time, you won't have a loan at the end, which is a disadvantage of this scheme. So, that's an option you have. But also, if you're really struggling, and, the banks are not happy to do part interest, part capital, there's a government scheme that they have called the Mortgage Charter. So as per that, there are some temporary measures in place until we sort of get through this difficult time period, for you to sort of keep your monthly payments down. So there are schemes like interest-only mortgages, but those are only temporary. So it might be worth considering those schemes if things like part interest, part capital doesn't work and you are struggling with the mortgage. Because the last thing you want is going into arrears, because that will affect your credit score, that will make things difficult for you to get a mortgage or even a loan from outside. So to avoid those, if you're really struggling, it might be worth looking at these schemes.
All right, thank you very much, Ifti, for explaining those in detail, because now we know that part capital, part interest is not the only other option that is out there, but we also have alternatives to that to manage the monthly mortgage payments. And also, I believe the key takeaways from this discussion today are, when you're going for a part capital, part interest mortgage, you need to make sure that you meet the criteria of the lenders, because they are quite stringent, and you need to have an acceptable repayment vehicle. You can't have your car, shiny new car, as your repayment vehicle. It has to be an acceptable repayment vehicle. The third key takeaway that I believe is that in the long run, you'll be paying more interest if you don't convert the interest portion of the mortgage to repayment, or else you're going to be having a huge amount to repay at the end of the mortgage term, isn't it? And of course, the alternatives you just mentioned, like extending the mortgage term, the mortgage charter program, I think they're all brilliant, fantastic solutions that are on the table for people to consider. So once again, thank you so much, Ifti, for joining this podcast and eloquently explaining all of these options that are available to us as homeowners and first-time buyers as well. And thanks to all of you for watching this video. If you like this video, please smash that like button, subscribe to our YouTube channel, and also share this video with your families and friends, because this video might be useful to them, especially if they're on a mortgage and are looking for options to reduce their monthly payments, while also speaking to a mortgage advisor so that they can get customized solutions to their personal circumstances. If you have any questions at all, we are more than happy to answer them on the comment section below. So feel free to comment your thoughts, your questions. We'll be happy to answer them. And once again, thank you to you and thanks to Ifti as well. We'll see you guys on another episode of Let's Talk About Mortgages with another interesting topic. Until then, see you.